Good morning, everyone, and thank you for joining us today. For those of you who don't know me, I am Becky Mars. I'm Head of Fashion Membership here at UKFT. Today, we're delighted to bring you a Business 101 webinar titled Managing Exchange Rate Risk to Protect Your Bottom Line, which will be delivered by Tobias Woodward, Head of Partnerships for Corporate at Smart Currency Business. If we can just go through a little bit of housekeeping before we start. Toby will deliver a short presentation followed by a Q&A. Please feel free to submit your questions at any time using the Q&A box and we'll address them at the end of the session. Just a bit of a reminder for our members, UKFT is the largest network for fashion and textiles in the UK. As the industry's leading trade association and sector skills body, we are committed to delivering sustainable growth for the entire UK fashion and textile supply chain. We offer practical advice and technical support to help member companies grow and trade internationally. We have an extensive range of resources, guides, on-demand webinars and live events taking place this year, which include roundtables, workshops and conferences. Please do get in touch with us for any resource access or if you'd like a full list of the events that are taking place. Back to today and the webinar, we are delighted to be joined by Smart Currency Business, an award-winning international money transfer specialist, providing UK businesses with bespoke currency exchange solutions. Smart Currency Business offers dedicated guidance on a range of tailored strategies to help companies mitigate currency risk and protect underlying profits on their international transfers and payments. Toby, over to you.
Thank you very much. Okay, everyone. Well, welcome to today's webinar. Thank you for that introduction, Becky. My name's Toby. I'm the Head of Partnerships at Smart Currency Business. Smart Currency are a risk consultancy and broker, and we're a national partner for UKFT for currency risk, foreign exchange, and payments. So today we're going to be talking about the currency market itself, how much volatility there is, and the impact that this can have on your business, how this can potentially affect your cash flow going forwards, and things you should consider when you're hedging, what hedging products are available on the market, and what strategies there are to actually implement those different products. We're going to look at some banking predictions about where the dollar and euro might be against sterling up until the end of the year. And then finally, a bit about who we are at Smart Currency and how we might be able to support you going forwards. The whole presentation should take around 25 minutes. And as Becky said, there'll be a short Q&A at the end. So let's start with the currency market. So it's the largest financial market in the world, and around $9 trillion is traded every day. In fact, more is traded on the foreign exchange market in a single day than the stock market in a whole year. It's a very, very large market. 88% of those trades involve the US dollar, and 40% of these trades are done through London. And the market is broken into two types of people. There's speculators and there's transactional buyers. So speculators are people who are just buying and selling all day, trying to make money on the market. Transactional buyers are people much more like yourselves who are actually buying their currency for an underlying reason, for a product or service. So if I was going to ask you, what do you think is the breakdown by percentage of speculators versus transactional buyers in the market? You might think, well, it's 50-50, or it's maybe 60-40 between people just trying to make money versus people who are actually exchanging for a specific reason. I can tell you actually it's 96% plus speculative. So people just trying to make money. They're the ones who are driving this 9 trillion a day market. And it means it's a market driven by perception, fear, and greed. It means that the markets are fluctuating constantly, and it makes it very difficult for companies like yourselves to plan for your finances and plan for your cash flow. And negative market movements can add to costs, erode profitability, and reduce that cash flow. So let's have a look at some recent market volatility and let's see what we're dealing with. So here is sterling dollar over the last 5 years. You can see down here we've got our timeline from 2020 through to towards present day, and the exchange rate on the side here with highs of around 142 and lows down towards 103 to 106. And you can see that these have big peaks and troughs. Here I've got some more detail about what's driving this, and these big peaks and troughs are driven by different economic and geopolitical events. Essentially, every time there's a market shock, these speculators sell the pound and buy the dollar. The reason they do that is because US dollar is seen as a safe haven currency. And so every time the market doesn't understand what's going on, something unexpected has happened, the pound will sink. And we've seen that happen multiple times over the last few years. Starting with COVID, no one saw it coming. Big market panic, the pound fell 18%. After COVID, the pound started to rise, and we got to a high of 142, and all the banks projected sterling was going to keep rising towards 150. But then again, the unforeseen happened, and there was the invasion of Ukraine by Russia. That triggered a big market crash, and the pound fell from 142 all the way down to about 118. And just when investors thought the pound couldn't get any worse, Liz Truss said, hold my beer, I'm going to release a disastrous autumn budget, I'm going to crash the bond market. And we saw the pound fall almost to parity at one point. It got to a low of around 103 to 106 was the absolute low. And since then, it's made some recovery, but bounced around again based on interest rates, inflation, and Trump's very aggressive tariff policy, which I'm sure you guys know all about. The main thing to pay attention to here is the numbers. So fall of 18%, rise of 20%, fall of 27%, rise of 26%, and so forth. Let's have a look at sterling euro as well. Similarly volatile, lots of rises and falls. And it's again driven by speculators who are trying to stay ahead and react to economic and political data. Here we have a high of around 121 on the euro and a low of about 106. So what can we learn from these two slides I've shown you? Well, markets are highly volatile. They're very difficult to predict, and they can have a material impact on your financial performance. So let's have a look at this financial impact in a bit more detail and what it really means to people like yourself. So we're going to use sterling dollar as an easy example. Here, I put that exchange rate for over 5 years, the high of 142, running down to the low of 106. And really simply, what this means is if you have £1 million and you're buying dollars, how many dollars are you getting for that exchange rate? It stands to reason if the market's high, if the pound is strong and the market's at 142, you're getting a lot of dollars for that exchange rate, 1.42 million of them. Whereas if the market's very low, we're down at 106, you're getting very few dollars. It's almost at parity. What this shows is this is the current market around 134. Every time the market jumps or falls by 2 cents, it has a $20,000 impact on P&L per million. So last year in 2025, we saw a market high of 137 and a low of about 121. That means for every £1 million spent, it was a difference of $170,000 between the market high and low. And if we look at that over the full 5 years, that's a $390,000 difference when spending £1 million. It's a tremendous amount of money, and I'm sure people who are listening to this might be buying much or selling much more than £1 million worth. And so you can imagine how it can scale from there. So people often ask me, are there any common misconceptions that people have about the market? Do people not know about this? And the answer is, well, no, they really don't. And the biggest misconception is that people think it's all about just chasing and getting the best exchange rate. And sure, getting a good exchange rate is important, but as we've seen, there's much more to consider than just that. The truth is, it's much more important to understand currency risk and manage that risk and protect your bottom line. And I've got a few notes on this screen to explain that in more detail. So, what good is it saving 0.3% on your exchange rate if the market falls 10% against you? What could a 10% movement in rate do to the profitability of your business? And how much more would you need to turn over to make up that deficit? 83% of listed firms hedged during the referendum, and by contrast, only 22% of SMEs did. So let's have a look at how this can affect a company's cash flow. And we'll look at an example of someone's really simple cash flow forecast, and it's a CFO who decided not to hedge and what happened. So here we have a company that's forecasting that they need to buy $3 million a year, and they're buying it in clips of $250,000 a month. And you can see the months of the year running down here. They put in a budgeted rate, their cash flow forecast, and into their accounting system at 136. And that's simply because that was the rate at the time when they built the cash flow. That means they're forecasting each $250,000 to cost them £183,000, which is the metric based on that exchange rate. And overall for the year, it's going to cost them $2.2 million to buy their $3 million. But as we've seen, the markets don't stay still. And in this case, the market starts to fall immediately. And in fact, when it comes to January, they already are off their budgeted rate. It's fallen by a cent. And the market continues to fall into the 120s, into the 110s before making a recovery. Overall, their aggregated rate for the year is 123, not the 136 they had hoped. This means that rather than it costing them £2.2 million for their dollars, it's cost them £2.4 million because they've crystallized a foreign exchange loss every month. And it's cost them £237,000 more than they anticipated. That's a huge amount of money for a business that's only buying $3 million a year. Now, in this kind of circumstance, a business has an option, and that option is, can they just change their client pricing and try and push this cost onto their clients? Some companies can, but a lot of companies don't have the luxury of changing their prices every month to react to changes in exchange rate. We're using dollar here as an easy reference, but obviously it applies to any currency. So clearly, companies want to take steps to avoid this type of loss happening, which brings us onto the world of hedging and hedging products. So in really simple terms, what is hedging? Well, it means protecting against financial loss, or at least trying to mitigate against it. And a company would want to do this to try and stabilize their cash flow, their profit margins, and their bottom line. The most simple type of hedge is known as a forward contract. I'm sure this will be familiar to many of you. A forward contract is basically where you lock in an exchange rate for a period of time, and that period of time is decided by you. So in this example I've got here, the market's at around 137, and someone locks in an exchange rate. They freeze the exchange rate for a period of time, and in this case, it's till the end of the year. So the advantage of doing this is it offers complete protection against any negative downside market movement. This is someone who's buying dollars. So if the market falls towards 130, they're fully protected at 137. The disadvantage of this is if the market continues to rise and it goes towards 140, you don't participate in that rise. You are obliged at the rate that you've locked into. Once a forward's been booked, it can be used at any time, and that's called drawing down. So if you book this annual forwards, you could use it all on day 1, day 365, or in any increments at any time in between. Typically, if a forward contract isn't used up by the end of the term, it can then just be rolled on and extended. Hedges like this often are subject to margin call terms, and that's something you should ask your provider about. So next is thinking about what considerations you should have when you're building out a hedging strategy and a hedging plan. And the obvious one is, we've seen, what if the market falls? What if it went 10, 15, 20% against you? What would the impact be on the business? The next thing to think is, well, what if the opposite happened? What if the market rises? What if you hedge at 120 and the market goes to 135 on the dollar? Could you lose your competitive edge compared to other people who might be competing with you? And what would that mean for the business? Do you have budgeted rates that need protecting? And if you don't, should you have a budgeted rate in the business? What are your profit margins like, and how much bandwidth do you have for foreign exchange losses? If you've got very wide profit margins, you can afford to take some of the stormy weather that comes with these markets. And if you don't, you really can't. How much flexibility is there in your pricing? Can you quickly change your client pricing to react to markets? And if you can't, that's something you need to consider. What's your business's overall attitude to risk, and how accurate are your forecasts? Is any flexibility needed in the hedges you're going to put into place? Finally, how will this be valued at year end if you put hedges? How are you going to report on those hedges going forwards? All these things you need to consider. So far we've talked about forward contracts, which is a type of hedge, it's a product. And we've talked about things to consider when you're building a strategy. Now, there's a few different ways of applying a forward contract or any hedge you might want to do. And each one of these different strategies will have a different result. So here's 4 different ones here, and we're going to run through these at a very high level. We're going to start with a static annual hedge, then look at back-to-back, layered, and rolling. So really simply, a static annual hedge is when someone books a forward contract or any hedging product for 12 months, for argument's sake. This is very, very helpful if you have a budgeted rate to protect in your annual cash flow forecast, or you're looking to create a budgeted rate. And it means that all your client pricing can be run from this one rate, which helps you stabilize your finances. It's a very, very common thing that people do. So for an example, someone buys $10 million to run from January to December, and they draw down on that every month. So the clear advantages is you're protecting a set rate in your accounts, which is great. The considerations here is there's quite high concentration risk on the time that you're booking. Imagine if you only book one forward contract a year, and that's at maybe your year end for the following year. Depending on where the rate is at that time is going to be very critical. And you can create a bit of a cliff edge effect where one year the rate's at 120 and the next year the rate's at 135, and that can be quite an adjustment for your pricing. This isn't binary. If forecasting is a problem for you, you might want to only book 75% of your currency exposure and leave the rest to the spot market. The next is a back-to-back hedge. So this is better for businesses that don't have annual considerations, but instead they price things per project or per job. So they're pricing things individually. Or it's for someone who might be buying an asset from abroad or selling an asset internationally and receiving funds in, and typically paying for that in stage payments. So an example of this would be a factory has to buy some equipment, and it's going to cost them 5 million euros. They've got to pay this off in 4 stages over 6 months. They might put in a 6-month hedge to lock in the cost of that item, and you could do that multiple times. So you're backing a hedge with a given project or a given cost. This means that you can have multiple contracts a year, which shouldn't be too much of a problem, but it's only suitable for some business models. Next, we have the layered hedge. This is very effective if your forecasting isn't very good, because at any given time, you're only 60% hedged, and it helps you try and achieve a blended rate over a period of time, or trying to get a mid-market rate. In this example, someone hedges 100% of their short-term known exposure, and then that hedge diminishes as the year goes on. So, for example, they've hedged 100% of Q1, 75% of Q2, 50% of Q3, and 25% of Q4. They then top that up every quarter, and they keep that rolling. So you're only 60% hedged, and by Q4, you have a blended rate of the last 4 quarters. The advantages of this is a blended rate over time. The disadvantage is that there's no minimum protected rate. So it's quite hard to price your clients from, because your average hedge rate will be changing every quarter. Finally, we have the rolling hedge. Really simple. This is basically just what we talked about earlier with that 12-month forward contract, that 12-month hedge. The only difference here is, rather than booking one year and waiting 12 months to book the next one, you top up every quarter. So here, look, someone's booked a forward contract for a year, and then every quarter they then just top up and top up. And it means that at any given point, you always have a 12-month hedge. And it means that by the second year, you achieve a blended rate, and that can be of the last 4 quarters or the last 12 months, depending on how you want to do it. The advantage of doing this is it reduces that cliff edge effect between financial years, as you're getting more of a blended rate. So there's less concentration risk on the date booked. I appreciate this is a real whistle-stop tour of a lot of these different strategies, and I'll be happy to speak to anyone about it in more detail afterwards. So far we've spoken about forward contracts, and we referenced other types of hedges. So another common product that people use is called currency options. We're going to cover this in very high detail. So these are regulated products, and a vanilla option gives someone the right but not the obligation to exchange one currency into another at a specified rate and date. The thing to really think about here is you have the right, but you don't have the obligation. A premium is charged for this because you're having protection and flexibility. So it's charged, a premium's charged a bit like it would be for an insurance policy. So to make that a bit more simple, imagine this would give you protection like a forward contract gives you protection from any negative downside market movement, but you have no obligation. So you get to walk away from that trade and just trade at the spot market if the rate improves. There's lots of different types of options products available, depending on how much premium you're willing to pay, the level of protection that you want, and how much participation that you'd like. Many companies don't want to pay an upfront premium for this, and instead they opt for absorbing some of that premium into their rates. And so they would secure at a worse rate than you would with a vanilla option, but it means that you have a limited upside, but it avoids paying the premium. Lots of different options, probably one to speak about after the call if anyone's interested in exploring these further. So let's look at some banking forecasts and see where they think sterling dollar, first of all, is going to go over the next 12 months. Apologies for this deeply unattractive graph we've pulled from Bloomberg. This shows banking predictions from a load of major banks. There's about 8 of them on here. We've got Barclays, BNP, Citi, JP Morgan, Santander, etc. Uh, the most bullish one out there is Commerce Bank, thinking cable's going to be at 140, whereas others are more pessimistic, with Citigroup thinking it's going to be as low as 124, and the average is 131 across those banks. Looking at sterling euro, Credit Agricole think the market's going to be as high as 118, and BNP Paribas think it's going to be as low as 109, with the average around 114. These banking predictions change quite regularly, and I could have pulled even more banks. They'd have all have had different ideas because the market is so difficult to predict. So let me tell you very briefly about who we are at Smart Currency and how we might be able to support you as a UKFT member. So most people buy and sell currency through their bank, their incumbent, but they really often offer just an online platform to trade through and not much else. Treasury consultants can be hired to help you as a company understand these risks, but they're expensive and you can't book any trades through them. Brokers are in the market, but they often just focus on saving people money on their exchange rate and don't really sit down and help you build out a hedging strategy. Whereas here at Smart, we do everything. So we help people understand the risk they're facing. We help them manage that risk. You can book the trades through us, and then we can help you monitor and develop this going forwards. If you wanted to speak to us, it would come in 3 different parts. It would be an initial fact find, where we'd understand your business model and ask some of the questions we suggested earlier about your budgeted rates and pricing and contracts. Once we understood your business, we'd go away and analyze the market. And on the back of that, we would create a board-ready currency risk analysis for you. And we do that absolutely for free. It's great because you can take the analysis away. It's a full audit of any decision making you might want to have, and everyone can discuss and agree it. If you like this free currency risk analysis that we've created for you, you can then go on and open an account with us. They open very quickly, and then we're a fully fledged brokerage, so you can buy and sell the currency through us, book all your hedges, and send and receive payments. The key thing to think here is you're already paying for your foreign exchange. The only cost we charge is swapping one currency into another, and you're already paying for that. This isn't about adding cost onto your business. It's about managing profit margins, cash flow, and bottom line going forwards. At this point, many companies think, well, great, you've helped me understand the risk, you've built a strategy, we've agreed it, we've booked the trades. What do I do now? What about year end? Do I track these in a spreadsheet? What do I do? We take care of that for you as well with our free treasury technology. It's amazing for board reporting. It's FRS 102 compliant, which means it will cover all your valuations at year end as well, and it can map out all your cash flow for you. And that comes as free as part of the service as well. We've been around for 20 years. There's over 150 people in the business. We're regulated by the FCA, and we trade billions in currency per year. Right, coming to the end of the presentation now, here are some final thoughts from me on what we've discussed today. The currency market is highly volatile, and we've seen it's highly unpredictable and very hard to forecast. If I can get you to take away one thing from today, it would be, don't just think about chasing a cheap exchange rate on the day. Profit margins, cash flow, and bottom line can be eroded from currency movements. It's really important to think about the strategy, both if the market goes up and down, because it can both impact your business. There are different products in the market, and there's different ways to apply those products to achieve different results. It's not just about booking a hedge and thinking you've done it. Far from it. If you're interested as a UKFT member, come and speak to us, and we can build out a free currency risk analysis for you and help you protect your business. Thank you very much for listening. If anyone's got any questions, I'll be happy to answer them, but otherwise, happy to speak to anyone after the call as well. Thanks very much.
Thank you, Toby, for the presentation and for sharing your expertise and guiding us through this topic. It's been really valuable to understand what market volatility entails and its impacts on the pound, along with understanding how smart currency would start formulating a currency strategy for our members. As Toby said, if any of you have queries, do follow up with Toby. He'll be very happy to connect with you. We have a couple of questions, so I'll just start with those. So first up, what does a best practice FX risk policy look like?
Best practice FX risk policy look like? I think the best practice one would be to consider all the options. I think you've got to consider if what would happen to your business if the market rose by 10% or fell by 10%. And then think about your forecastability as a business. So you're not over or under hedged, and you can calculate how much flexibility you need. Look at the underlying P&L and how that could be affected, and then work out based on the products available which one's going to be best for you, and then what metrics in your business you should be applying any particular hedge to. I would say if you've got more questions, come and speak to us, even on an informal basis. We'd be happy to talk you through it.
Thank you. Another question is what are some of the most common mistakes that CFOs make?
Yeah, interesting question. I would say people who either totally ignore their foreign exchange exposure when it's actually important to their business because they don't understand it and they don't understand the risks. Many companies aim for a certain profit margin, it can be 20% a year. And at the end of the year, they've made 25% or 15% and they don't know why. Often things like foreign exchange is one of those key things. So I would say common mistakes are people overlooking the importance of it. I think sometimes it's also people just booking random hedges without any clear plan. Because if you just book a hedge without really understanding the market and what you're hedging against, it can be the right thing and it can be the wrong thing for the business. So a hedge just isn't a panacea for all ills. It's important to really give it some thought. I think some people don't really understand when currency risk really starts and stops. They think it's when the invoice lands with them, but really it's when underlying contracts are being made. So there's a few layers of the onion people have got to peel back to really understand it.
And how common is hedging?
Very common, I'd say. I think if you've got to buy and sell a little bit of foreign exchange, but it's a tiny fraction of your overall turnover, it's less of an impact. But as soon as people start buying over a certain amount or selling over a certain amount, I think most companies will have a hedging strategy or policy. Absolutely.
Okay, I think just one more. What mistakes do you see most often in volatile and or emerging markets?
What mistakes do I see in the markets?
Do you see people make most often?
Yeah, I think like what I was saying earlier on, I think it's just I think people are just overlooking the importance of how significant the market can move and what if it keeps moving in the wrong direction. For example, some people say, well, I'm going to hedge and I'll only hedge when the rates are good, which is fair enough. The market moves up and down, but what happens if the market keeps moving in one direction and the rate doesn't become good again? And what if all your client pricing then starts to move offside and suddenly you're making a loss on certain contracts? It can be a very dangerous policy to have. So yeah, overlooking how significant that market movement can be on top of those other things I previously mentioned.
Thank you. And sorry, we do have one more.
Great.
What does your free currency risk analysis look like? As in what?
Yeah. Okay. So it would be us having a conversation with you about your business. And then we would go away and generate this analysis and we come back to you. Basically, it's a PDF and it covers our understanding of your business, the market that you're in and how much volatility there is, the impact on your P&L per currency pair based on recent market movements over the last 5 years. And then we look at which strategies are most suitable for your business model and which products are. and then we package it up for you. We discuss it with you. We don't give advice, only guidance. So we say, look, this is your circumstances. Here are the products. Here's what feels right for you, but the decision is ultimately yours. And then you can go away and have a think about that as a team. The nice thing is you can get consensus with your whole board about what you're going to do, and the full decision-making process is outlined in that analysis.
Perfect. Thank you so much. So, thank you for answering the questions. I'm just going to signpost to the members what we have coming up next, which are free to access the webinars for all of our members. On the 12th of February, we have a Sustainability 101 webinar. We're Wildlife Friendly Enterprise Network, and the UK Business and Diversity Forum will be offering a practical introduction to UK business, to UK businesses into nature, biodiversity, and fashion. And we will also have our compliance team hosting a reuse and recycling overview on the 24th of February. This will focus on the sector landscape and what this means for global trade. A huge thank you everyone for joining us today, and we look forward to seeing you very soon at an event or future webinar.